Good morning, everybody. What I will do today is give you an update on the outlook for U.S. monetary policy after the Federal Reserve rate hike yesterday. I think Jerome Powell had a very good first press conference. He delivered very well. He left really no uncertainty about the future outlook for monetary policy in the U.S. And I think, frankly speaking, it's an improvement compared to Janet Yellen, who prefer a much more discretionary way of thinking about monetary policy. What Jerome Powell really is getting us into is a much more rule-based monetary policy. And I'll try to talk a little bit about that, and based on that, on the outlook for the Fed over the next 12 to 24 months in terms of rate hikes or cuts. First of all, when I listened to Jerome Powell yesterday, I got the very clear impression that Powell is eager not to rock the boat. He's eager to have monetary policy conducted in a transparent way, in a predictable way, and I think he delivered on that very well. We have already heard from Jerome Powell that he said that he looks at a number of monetary policy rules ahead of each FOMC meeting to assess how the rate outlook should be. So in many ways, I was thinking yesterday that this is really what one of my favorite economists and monetary thinkers, Robert Hetzel, have called lean against the wind with credibility. Hetzel, of course, a long-term veteran of the Federal Reserve himself, described the period of the Volcker, in particular of Alan Greenspan, as a period of lean against the wind with credibility. So how do we understand a lean against the wind with credibility? Well, essentially a central bank that controls monetary policy by using the interest rate instrument is effectively targeting short-term interest rates. It can do that by regulating expectations and by regulating the money-based growth rate. And then we also have to remember, if you have to target the interest rate, then essentially you can't target inflation. You can only do that if your inflation target is credible. So what it needs to be is having a regime where inflation expectations are more or less aligned with the target. So in the case of the Fed, 2%. And then you would move interest rates up and down with the business cycle, changes in savings and investments, productivity, unemployment, and so forth. And of course, this is what is reflected in different monetary policy rules, such as the Taylor rule, where the Federal Reserve would move short-term rates based on two factors: the deviation from the long-term inflation target in terms of short-term inflation, and the output economic activity. There are, of course, other variations of this. One is the so-called Mankiw rule, which says that the Fed should move rates based on a difference between actual inflation and the actual unemployment level. It's very similar to a Taylor rule. We can also think of this as the Federal Reserve moving rates up and down based on deviation from a long-term nominal GDP target, and so forth. And there are different variations of the Taylor rule where we assign different parameters and we can use different forecasts and so forth. And Jerome Powell has already talked about he's doing that. And we have actually done some work on this, and we have worked on 5 different variations of monetary policy rules, inspired very much by what Powell has said. And then we have used different forecasts for unemployment and different forecasts for inflation, to assess what would be the rate outlook for the Federal Reserve. So again, here it's very important that the Taylor rule works or rules similar to the Taylor rule works if inflation expectations are well anchored. And one of the problems with Janet Yellen was that during her tenure at the Fed, inflation expectations actually become unanchored. Inflation expectations drop somewhat below the 2% inflation target, and has been so for a while. But over the past half year or so, inflation expectations have become realigned with the 2% inflation target, both if we look at the market expectations and professional forecasters, including our own framework for medium-term inflation forecast. Presently, our forecast for two-year inflation in the US is slightly above 2%, assuming some tightening of monetary conditions, but probably 2.1, 2.2% is realistic to assume in the next 2 to 4 years in terms of inflation in the Federal Reserve. So overall inflation expectation has become re-anchored to the 2%. And therefore, as we also have moved away from the zero lower bound, the Federal Reserve can now conduct monetary policy by moving up short-term rates according to some stipulated rule, more or less directly defined, and then follow that. And by doing that, as long as inflation expectations are well anchored, the job of the Federal Reserve is essentially to move rates according to this. And this is very much what Jerome Powell really was signaling yesterday. More than anything, he was saying, okay, we will move rates according to what the economy is telling us. If unemployment is lower than expected by the Fed, we will hike rates more aggressively. Is inflation expectations higher than, or actual inflation is higher than what is presently expected by the Fed, we will hike more aggressively. But he also stressed that that was symmetrical. If we undershoot in terms of the inflation, and if unemployment is higher than presently expected, then the Fed will deliver that less. And even that, he also noted that if we are in a situation of a negative shock and the Fed were to hit the zero lower bound, we will switch back to using money-based control. So he's kind of already given an insurance on how he will conduct monetary policy if we were to hit the zero lower bound again. So what Jerome Powell yesterday really have done, in my view, is outline his monetary standard. Jerome Powell will move up rates up and down according to a not yet defined rule, but we probably have to think of it as, broadly speaking, some way of Mankiw rule, Taylor rule, nominal GDP targeting rule. We will figure that out. But all of these rules are more or less giving the same direction. From time to time they diverge from each other, but we can kind of get the idea of the direction of monetary policy given our expectations on economic activity and inflation. So that also means that to Powell it's not a question about being hawkish or dovish. And I think that's very positive. It's very clear he was not trying to be hawkish, he was not trying to be dovish. He was trying to lay out his framework, the Powell standard. And the Powell standard is probably one which is very similar to the Alan Greenspan standard, but probably much more well defined within terms of what framework there will be, and there will be less discretion than in the case of Alan Greenspan. That, in my view, is very positive. So what is the rate outlook for the Federal Reserve? Well, Jerome Powell has already said he looks at a number of monetary policy rules to guide him in how to think about rates going forward. We have done some similar work, and we will publish that work soon in different forums, and among other things in our quarterly Global Monetary Conditions Monitor, which we will publish next week. And I will give you a preview on that. So what we've done is we have looked at 5 different rules, and we have looked at how would those rules behave. The rules are a Mankiw rule, a Taylor rule, a so-called balanced rule was a variation of the Taylor rule where we have more aggressive reaction to unemployment. It's a nominal GDP level targeting rule, and it's a price level targeting rule. And those 5 rules we have then tested under different assumptions of unemployment, economic activity, different outlooks, and with different expectations in terms of both core and headline inflation. Based on that, we have made scenarios for the outlook for rates over the next 5 years. So what is very interesting is that based on all these rules, the median tells us that rates are probably a little bit too low relative to what these rules are stipulating. So there's probably around 0.25 percentage point rate hike just coming from the fact that rates are slightly too low based on that. The fact that rates are probably a little bit too low we can probably also see from the fact that inflation expectations have been accelerating recently. So if you keep rates below your rule, inflation expectations for the medium term should be accelerating. That has been positive. That has helped us bring us back to 2% inflation. But we are now at the 2% medium-term inflation outlook, and therefore we should expect on the medium term to follow these rules. Obviously, there are variations in these rules. Some are more aggressive, some are less aggressive, but they are actually surprisingly similar in terms of the outlook for rates over the next 12 months. Guess what? These rules more or less all indicate that we should have around 3 rate hikes from the Fed this year. We have already got 1, so 2 more this year. However, I think it also should be noted that if anything, the rules tend to signal less than 3 rather than more than 3. That means that the speculation of 4 rate hikes, in my view, is not something that is aligned with these general set of monetary policy rules which Jerome Powell already said he's looking at. Yes, inflation expectations might be on the upside, but it's not dramatically, and there's no indication that inflation expectations are becoming unanchored to the upside. Rather, it's pretty much anchored now around 2%. So therefore, our main scenario would be based on these monetary policy, based on what we could call Jerome Powell standard. We should expect 2 more rate hikes this year. But that's not really the most interesting thing. That's more or less also market pricing. The next question is, how about 2019? There's a lot of talk. Also, the FOMC yesterday signaled more rate hikes in 2019 with its famous dot plot, which I think we mostly should just ignore. I think dot plots is something that each participant of the FOMC sends some ideological signal, which is really unrelated to monetary policy. I don't find the dots very interesting. What I do find interesting is staff projections for unemployment, for GDP growth, for inflation, because we can plug that into some real defined rules, which General Powell would be looking at. So forget about the dots, but there is a lot of talk of further hikes in 2019. But if we use these rules to look into 2019, actually rates will peak already after these 3 rate hikes this year. We might get 1 more rate hike in 2019 if you look at the rules, but 2 or 3 rate hikes, there is no indication from looking at these standard monetary policy rules that we should have 3 rate hikes, 2 rate hikes, at the most 1 rate hike in 2019, and I'm not even sure that our models could support that. So overall, that's what we get from the Taylor kind of rules, or Manque rules, or nominal GDP targeting rules. And when we look at that, it's at the maximum 3 rate hikes in total this year. But we can also compare this to the communication of the Federal Reserve. We have done extensive works over the past year on forward guidance, and what we have done is that we are constructed a setup in which we have an algorithm which automatically reads monetary policy statements from different central banks, of course, including the Federal Reserve. This system is based on how many hawkish and how many dovish terms there is in each monetary policy statement. And if we apply this so-called forward guidance indicator to yesterday's FOMC statement, it was actually slightly less hawkish than the previous announcement. Not a lot, but slightly less hawkish. And if we look at what determines the hawkishness and the dovishness, we have made models to predict this from economic activity and inflation expectations, and it says that the more or less that the communications yesterday was pretty much as should be expected given the underlying macroeconomic fundamentals, economic activity and inflation expectations. And that's also what we saw. We saw little market reaction to the statement. It came out maybe slightly on the dovish side, and that's how the market reacted. And so what is that telling us? Can we use the forward guidance indicator and how we measure the actual language of the Federal Reserve to say anything about future rate path? Yes, here we're lucky. If we look at our forward guidance indicator, we have tested statistically this, and we have written about this, and we'll write more about that in the future. And if we look at that forward guidance indicator for the Federal Reserve, we can see that the kind of hawkishness/dovishness we have in the statement, if we look at how that normally corresponds to rate changes, it comes out something around 60 to 65 basis points rate hike over the coming year. So if we include the rate hike yesterday, that's not even 2 more hikes this year. So again, the forward guidance indicator pretty much is aligned with the different monetary policy rules we have tested, saying 2 to 3 rate hikes in the course of 2018, and we've already have 1. So if anything, it seems like rate risks are twisted slightly to the downside compared to what most commentators are saying. Of course, we have to weigh that against the fact that we think inflation expectations have slightly overshot the inflation target of the Fed, so the Fed might tighten a little bit more than stipulated by this, and that could then justify 3 hikes in all, but not a lot more than that, not 4 hikes. Furthermore, in terms of medium-term rate outlook, I think it's important to remember that the natural interest rates have declined very significantly over the past 10-15 years. And our own measure for the natural interest rates tell us that if we deliver much more than 3 or 4 rate hikes over the coming year, the actual Fed funds target would move above the natural interest rate in nominal terms, and that likely would be recessionary. So therefore, again, the natural interest rates puts a floor, not a floor, a roof to how high rates can go. So imagine that the rules are stipulating we should move upwards, but if we move above a certain level, that would mean that it would be necessary for the Federal Reserve to take out more money from the economy, to contract the money base, to push rates above the natural rate. And by doing so, the Fed would automatically cause a recessionary monetary shock. And there's clearly a risk that could happen. That often happens when the Fed become overly concerned about the business cycle and move too aggressively and then have to reverse course. I don't think we are there yet, but that is the challenge in 2019. I think General Powell knows this quite well. So I'm not really concerned about that. But again, I think if anything, the Powell standard is now being established. It's based on the fact that as long as inflation expectations are well anchored, he will move rates up and down from relatively well-defined monetary policy rules. We have now a toolbox to track those rules. I'm very happy to share those with our clients and future clients. And please contact us about the rules, and we can do that. We can test the rules on the different assumptions of unemployment, economic activity, inflation expectations, and so forth, to give a section about how is the rate outlook really for the Federal Reserve. But the Powell standard, I think, is a tremendous progress, and that's where we are now. It's at the Powell standard, but it's essentially moving rates up and down with economic activity and inflation expectation. It's what Hetzel called lean against the wind with credibility. It's back. I think we should all be very happy about it. It might make monetary policy less interesting because it's more predictable and transparent. But also, if you want to track the market pricing, look at these rules. Look at what the Powell standard is stipulating. We have made the homework on how to do that. We're happy to talk to you about in the future. Thank you.